Hello, everyone, and welcome back to another exclusive Boom Room interview. I'm Sasha from Arcanum Ventures. I'm here with my good friend and colleague, Carmelo. And today we have the pleasure of welcoming Jeff Cafolla, founder at Earn Network, an infrastructure company that enables easy access to yield bearing opportunities to anyone, regardless of technical or financial literacy. Jeff, welcome. Thanks so much for coming on. How are you doing?
Fantastic. Yeah, brilliant. Thanks so much for having me. It's good to be here. Looking forward to it.
Absolutely. I don't think we speak with many people that are deep in the world of DeFi. So I'm very excited to dive into this with you, but also Mello, I know, is very excited to speak with you more around your founder journey. You've been involved in some of our content in the past, and you've been an avid participant in our weekly spaces. And one of the reasons we want to talk to you is because you're so well spoken. You seem so knowledgeable in this space. Before we get into all of these things, if you don't mind, we're going to ask you the same boring question we ask every participant in the Boom Room. Give us an idea of how you came into the space. How did you develop an interest for the world of cryptocurrency, blockchain, and more specifically DeFi? And how did you come into becoming a founder at Earned Network?
Yeah, I mean, break it down. Started out back in 2017, actually. So, OG, I suppose, not an OG, but an OG. So yeah, 2017, I heard rumors. I heard about cryptocurrencies and I was never really into it. And then a random friend of mine said that his brother and his mates were making loads of money off this cryptocurrency stuff. And I was like, right, I gotta find out what the hell is happening. So got onto Coinbase naturally as you do, got absolutely annihilated with fees. I think we spoke about this on one of your spaces as well. Like unbelievable the fees they charge.
Yeah.
Bought some Ethereum. I was like, great. Obviously, it wasn't moving quick enough, so I sold into Litecoin. Litecoin started to pump. I was like, this is great. And then I rotated into some shit coins and like real shit coins that never really returned. I think overall I managed to get like a 5 or 6x. I joined sort of late 2017. So I got like a quick 5 6x in the space of like a month and a half. And of course, I held onto it and rode it all the way back down to below my original investment. And then like just started chucking in more money in 2018, 2019, and obviously onwards and upwards. Um, in terms of DeFi, I say back in 2017, it was more just like trying to get money, right? That's what everyone does. They throw money on
Right.
any token that they think will go up, or they like the sound of the name of, or they think, it is low price and, they don't understand anything about market cap. They don't understand anything about tokenomics. They just think, oh, this is $1. If it goes to $1,000, I'm going to be really rich. And realistically, it would never do that. But just the typical stuff you always have. And then I started to sort of get into DeFi a bit more. I started to understand maybe in 2020 the different categories of crypto. And for me, DeFi has always been like one of the most obvious use cases for cryptocurrency and probably one of the best use cases for crypto. I mean, across the board, I think it can improve every single industry. But I think DeFi really, for me, I've always said finance for me is yet to have that sort of Netflix moment, that Spotify moment, right? Just the thing that comes along that just flips the entire industry on its head, and everyone is scrambling to compete. Neobanks have done a good job of that, I think, to date. With easy access, instant payments, instant FX at low cost, and all the rest. They've done a great job of that. But in terms of earning, it's still not there, right? And I think DeFi offers this incredible opportunity for people to earn much, much higher interest rates, auto compounded every 24 hours, and to generate real wealth. But of course, it's highly inaccessible. And we'll obviously talk about how we're trying to fix that. And so, yeah, I worked in many different companies in crypto. I actually worked across GameFi, I worked across DeFi, Layer Ones, AI companies, ORWA, and a whole host of other ones. And back in 2024, I've had this idea. We reiterated, and I saw, okay, we've got a good sort of baseline plan here of what we want to do, how we want to achieve it. And so I decided to go out myself in 2024, put my own capital behind it to bootstrap, raise a small amount, and basically just kept building, and then pivoted, and yep, here we are now.
Amazing. Yeah, actually, you kind of started to answer one of the questions I had for you, but why DeFi? But it sounds like you've worked in almost every mini micro niche in blockchain or Web3. So why did you decide to come back to basis with Earn Networks and work in DeFi specifically? Is it because I would guess it's the thing that got you into this in the first place?
Yeah, I think gaming's great, but games are pretty solid as they are now, right? You don't need a game on the blockchain. You have open world games on the PC. You have MMORPGs. You have sports games. Like gaming's pretty solid. You don't really need to have it on the blockchain. So for me, gaming is like it's not an absolute must. It's not going to revolutionize everything at this moment in time. I think having NFTs and customization stuff is cool, but that's still stuff that you can do in a normal game, like digital collectibles and things like that. So for me, gaming is getting there, but it's not quite there. And I think other things like you know decentralization of servers, like sort of competitors to AWS and other companies like that. I think it's a cool idea again, but again, it's not absolutely necessary. I think what's necessary from my own personal point of view is banks are taking your money in. This is a very simplistic view. Obviously, banks are taking people's money in. They're giving you like 0.5% interest for your money or 1% interest for your money. They're loaning it out at like 5, 6, 7, 8%, depending on if it's a short term or a long or medium term or long term loan. They're printing money, they're borrowing money against central banks. They're printing money, which causes inflation, and so there's this real big problem where people are saving in banks. They're making absolutely no money off the interest. The bank is actually making money off of your money. It's a really weird dystopian business if you think about it. And people are stuck in between a rock and a hard place. If they want to make money, they have to go to the S&P 500 or stocks or invest in crypto, and that's volatile. And people don't want to do that with money they're trying to build wealth with or save for a house with. And so DeFi, as you know, offers incredible double-digit yield opportunities every single day. But the problem is, number one, they're dynamic, right? They change every few seconds or every block or whatever it might be. So it's very difficult to optimize that. And then number two, it's just really difficult to get into DeFi, like having to set up a hot wallet, having to, load your wallet with the right gas, with the right funds, deposit into the right protocols. It's a bit of a minefield. Um, but I think there's incredible opportunity to bring that to the real world, as we say, or to sort of everyday people, so they can also benefit from these incredible investment opportunities.
Hmm. Yeah, want to say real quick, shots fired on the entire GameFi industry there. I mean, there's so many builders and big companies in the space trying to get in, believing like, oh no, there's opportunity. And that's definitely a topic for another discussion I think would be fun to dive into. But I completely agree. Like DeFi it's a really interesting thing, and it's a completely different skill set. On one hand, you have the technical literacy that's necessary to be able to interact with a lot of this decentralized infrastructure. On the other hand, like banking applications, banks and their platforms and whatever they're building, they want to try and offer some of these types of opportunities, albeit in a financially reasonable way for themselves. But opening a bank account can be very limiting, and if you're from a certain part of the world, and so it's like a completely different user journey there. And I want to get back to Earned Network and what this kind of journey looks like, and what you guys are trying to tackle, because I know from the documentation that you guys offer, from the website, and from what we've spoken about before, you guys are trying to tackle a lot of these issues when it comes to like account abstraction, simplifying user journey, streamlining access towards yield bearing opportunities so that anybody that's interested in just not having maybe their fiat currency be constantly devalued year to year can access something that they're going to be able to let's say accrue some value just passively. So give us an idea more about like what you're trying to accomplish with Earn Network. What are the types of products or features or services that you guys offer, and how are you competing in a very competitive space within the crypto landscape?
Yeah, great questions across the board. So I will start by saying that in sort of late 23, early 24, when we really kicked this off, we were very B2C focused, right? And I'd like to say that we were sort of ahead of the DeFi curve. It wasn't really a thing when we were building. It was more called AI-fi, actually, which I think is a much better term. I don't know who butchered it. Somebody came
Oh
along
yeah.
one day and called it DeFi, and that's it. It stuck. The power of the KOLs. So yeah, we were building this. The idea basically initially was we wanted to basically connect everything. Well, the major opportunities in DeFi across different chains, different protocols, and different assets, all into one strategy. And it was stablecoin specifically. So the three stables we chose were USDC, USDT, and DAI. The idea is you could deposit USDC, USDT, or DAI into the single strategy, and you can earn across all three. And you can earn across all three across various chains as well. So it's fully interoperable. So a user can come along with their USDC on base, they deposit that into the strategy, and tomorrow they could be earning a portion in DAI on Arbitrum, or a portion in USDT on Polygon, or even non-EVM chains as well. Sounds complex. It is extremely complex. And so what we found was we got loads of data off that. The problem is, obviously, you want to rebalance frequently to capture the best yield opportunities. When you rebalance with a tri-stable strategy, every single time you move in and out of a stablecoin, you pay a small amount of slippage. There's no fees, but there's a tiny amount of slippage, about 0.5 or even 0.1% or 0.05%. You can actually hard code that in and say, I don't want to pay anything more than 0.1%. But if you rebalance every day, after 10 days, you're at 1%. After 100 days, you're at 10%, right? And now you've eaten all of the yield that you could possibly generate. And then on top of that, the way that the interoperability works, it's like you have to sell your DAI into USDC, burn the USDC on chain A, mint it on chain B, and then swap it back into DAI or USDT. So it was just an absolute minefield. So we did this initially, and then basically we moved to a couple of different chains who we had partnered with. And then we said, like, look, this really isn't working the way we want it to work. We're going to simplify the strategies into single stable strategy, so USDC only or USDT only, and then we'll be able to rebalance more frequently. And then we ran the simulated data on that and the actual real world data on that as well, and we found it to be better. The problem is, as we discovered in DeFi, and we can talk about this, is that DeFi as a whole is a fugazi, right? It's all smoke and mirrors. There's literally no capital in DeFi at the moment. You have a couple of whales who go around, do LP deals. They get the base yield of 5 or 10% plus 20% or 30% of your token. And then they farm the shit out of your token. And then you launch your token and they dump your token and they suck out liquidity and they put it in the next opportunity. And that's literally what happens. The merry-go-round just goes round and round. And this is why like 90% or something of DeFi protocols fail within 12 to 18 months. Like you said, super crowded, same people doing the same thing, whales getting super wealthy, and yeah, everyone else just left by the sidelines. So we actually found this out when we ran our closed beta, and we had like over 1,000 users, and this was like, oh, this is solid. And then we looked and we said, okay, well, we have around 100K in TVL. It's like, that seems super low. So I spoke to one of our partners who was like a fork of Aave, and I said, look, there's no data on this. Like, despite the blockchain being super transparent, there's no data on like what the average wallet value is for deposits or whatever else. I said, can you give me some information? Because Aave is not going to give it to me. He said, yeah, no problem. So he came back and he goes, the average wallet deposit value is $9,500. And I was like, that's incredible. That's huge. $9,500. He's like, yeah, but the median is $17. I was like, okay. So nobody spends any money in DeFi. Like, you have a couple of whales that basically prop up everyone else, and that's just the way it is. So I was in Paris Blockchain Week. I was a finalist one of the sort of the pitch competitions. And I went up with this whole thing, and people were saying the same thing, which I heard for a long time, which is, this is super competitive, man. Like, what are you doing? Like, you're going to need millions to even get, customers. And I'd spoken to somebody else who's in the B2B side of things in crypto, working with sort of an API type to make DeFi, not yields accessible, to make DeFi generally more accessible. Yeah. And it got me thinking. I got rinsed by the judges anyway, and it got me thinking. I was like, right, time to go back to the drawing board and think about what we can do here. And, the real value that we saw was actually in the infrastructure that we were building. The network, the middleware that we're looking to build, that connected people to these yield opportunities, because the idea ultimately is you can deposit on Base and then tomorrow you're earning on Solana or Sui or Aptos. And the model basically looks to predict future yields and also allocate the capital based on the best opportunities or the most profitable pools that day. We can get into the more technical aspects of it. But that alone is also very powerful because most people can't optimize. Most businesses can't optimize DeFi because when they do, they have to pay fees for every deposit and withdrawal. They have to pay slippage if they want to swap assets. They have to, pay a fee for bridging. So there's problems there as well. So we said, well, what we'll do is we'll take the tech that we have, we'll spin it up into an API, and then we'll allow any business to connect to DeFi yields or RWA yields via our API. And so therefore, we don't have to go after the users. We go after the businesses and their users come to us via the API that we have. So we changed the model, went to Token 2049 in Dubai with it, spoke to a load of people about it and had a lot of interest. So that's where we are now. We have a good few LOIs signed as well from different companies. We're looking to build that out and then, release the first batch probably, I'd say Q1 of next year, with the first sort of integrations for those APIs and take that step. So that's the pivot there that worked for us. And that's how we sort of, I think, differentiate with a competitive market, as you say. Now, uptake remains to be seen. It's very difficult to know how many users will actually use it, but so far a lot of businesses are interested, so that's good news.
Amazing. Yeah, actually, this kind of the part two to the question before too is like you let us know why you got into crypto in the first place, but what was the aha moment that made you want to start Earn Network? And if there is any true competitors out there, anybody doing anything close to what you're doing, how do you see this as like enough of a use case or an improvement that you're like, this needs to happen? And why do you think that excitement came in Dubai for Token 2049? Like why everybody was excited about this?
Yeah. So I think first and foremost, the aha moment, as I said, was I'm seeing these yields that DeFi offers, and I'm seeing what's available in the real world, and it just doesn't compare at all. And then I saw like some more simplistic solutions that would connect, directly to an Aave pool, but on one specific chain. So they would allow users to deposit USDC on, let's say, Ethereum, and then they can lend that out in the app, which would earn on Aave. And I thought that's a very rudimentary way to do it, but it's pretty cool because now you have, this ability for people to deposit USDC. But the problem with the complexity is, again, USDC, BNB chain, Base, Polygon, Sui, Aptos. Like people need to understand what these chains are. And so that becomes problematic as well because you add another layer of complexity. If somebody sends Polygon USDC to it instead of Ethereum USDC, they lose their money. So you need to have this situation where you can pretty much take ideally all chains, but at least the major chains that people could deposit on any one of those, and it doesn't matter, right? So that removes a certain layer of complexity. So for me, seeing the ability to then, as interoperability is kicking in and I'm looking at this, and again, like this is like obviously an obsession of mine, I'm seeing like how we can make this work and how we can actually generate better yields. And then we run the data and we go, this is actually, quite significant. We can actually do quite a lot here. The yields on Aave alone are nearly double if we optimize them versus an average Aave pool. Without using any other protocols, just Aave across like 10 different chains, you can almost double the yield. So it just goes to show how good optimization actually is for generating yield. So that for me, I was like, okay, this is a great idea. And then going to Dubai, just started talking to people. They say, well, what do you do? This is what I do. This is what I'm, this is what we're sort of focusing on, a more B2B aspect of it. And we spoke to people who had games, marketplaces, launch pads, you name it. We spoke to them and people were like, yeah, I mean, put me down, be interested in having a chat. We were really there to sort of socialize the idea and validate the idea, but also to get some initial interest as well. Perp dexes and things like that are also, a couple of projects that we have lined up there. So overall, I think, that was for us a decent enough signal where we could go, okay, let's go with this and let's see how it goes and where it goes. So we've spoken to a lot of them since, and people are still quite keen on that. In terms of competition, I would say of course there's going to be competition regardless, but it depends on what you would consider like direct competition. Is there somebody who's doing it exactly like us? Not that we found so far. Are there people who are doing it similar to us in different ways? Yeah, of course. But I think where we really sort of focus on has actually been to our detriment as well, to a certain extent, is the multi-chain aspect or the omni-chain aspect, right?
Mm.
This
Yeah.
idea that, hey, you can deposit on Base but earn on Solana. Like, it's great from a technical perspective because now it opens up all chains, all protocols, and assets. And you go, wow, that's great. From a founder's perspective, it was terrible because we have no native chain, and so no chain wants to back us. No chain wants us to be like number one. So like, oh well, you're working with all these other chains. You're in bed with all these other chains. Like, why would we go to you? So this idea that I had, this interoperable sort of yielding, which is really cool on paper, sort of screwed me, I say. So anyone listening who's thinking about finding the business, go single chain first, and then when you're in bed with them, then go multi-chain because you already got the gift. So
Oof, that's the
Some good
alpha.
advice, actually.
yeah,
Yeah. It's really interesting because this is a funny enough a common story, like a common founder journey in a lot of companies within our portfolio, advisory clients, and just founders that we meet in general. And it makes perfect sense when you like dissect it. You've got all of these trailblazers when it comes to developing a lot of technological infrastructure. You have some like vision or some goal in mind, like I want to accomplish this. I want to be able to offer yield on some of these different liquidity pools and like this aggregator, etc. But you realize that the infrastructure and the tools that you've built are that they've kind of like blazed the path for all of these other institutions or other builders or other players that are coming in behind you. And so it's really funny to see that, all these companies are like they build SaaS models after the fact, but it's valuable, right? There are a lot of companies that do need this infrastructure. And I before we move ahead, I'm really curious on the technical side of things. One of the biggest blockers for many companies that are building this sort of like interoperability infrastructure has been the reliability or security of bridging tech between some of these networks and these different blockchains. And from your own perspective in building in this area, like how have you seen that evolve? Like, do we have very reliable bridges? Are they safe? Is there a lot of liquidity behind them to settle transactions instantly? Because I think the last time I tried to use a bridge, it was like 5 or 10 minutes before I got my funds from like Base onto Solana.
yeah, great question. So I mean, bridges have significantly improved since we've seen like a lot of the hacks initially. But I would say still, to me, I'm still not comfortable using bridges. So we actually use more like interoperability networks. I mean, I know bridges are interoperable, but we would use things like CCIP, CCTP, burn and mint mechanisms, right? I don't like the idea of lock, unlock, or wrap, unwrap. I prefer burn and mint, right? So you burn on Base, you mint on Solana, right? That's much easier, and you do it through the likes of USDC, who have their own interoperability network. You do it through USDT Zero, who've created this themselves, and they've got really deep liquidity, right? And so for me, like the way that we're tackling this is and this is also sort of, screwed us in a way, is we're not focused on like the 20-30% APYs where there's high risk. What we want to do is we want to bring DeFi to people in like the most secure way possible. And so we use tier one protocols, right? So we will use like Aave, we will use Camino on Solana, like only the tier one, right? And we use USDC because it's IPO'd, it's over collateralized, it's MiCA compliant, it's Genesis, is Genesis, is that what it, Genius compliant as well, right? The new laws in the US. So you have to choose tier one assets, tier one protocols, tier one chains. And this is where the liquidity depth comes in place as well, because it's super important. And we can talk about the tech behind the product and how we use a lot of that to protect users' funds. So for us, we use tier one, like Chainlink, CCIP, right? Because for us, the most important thing is security and longevity. I think a lot of people in Web3 have this really short term, like, or short horizon when it comes to thinking about a product. They think about something in a year in advance or 6 months in advance or what's available now. Whereas you want to be thinking 5-10 years down the line, right? You want to be thinking, oh, can this product be used by, fintech apps or banks? Can this app be used by pension funds at some stage? Maybe not, but if you can show reliability over 10 years of security and continuous results, that's a conversation you can potentially have in the future. So I think people think too short term. And I think that's in line with the sort of the quick buck that you could try and make in crypto, right? A lot of people are in it to try and
Yeah.
make money super quickly. I mean, everyone wants to make money, otherwise you wouldn't be in crypto. But I think there's some people who want to be extractive, and there's some people who just want to give and then hopefully make something big and impressive and amazing that's never been done before, you know? So
Yeah, this is also sort of a ties in with the technical aspect as well. It's more of a philosophical question, and it ties back to what you said about the $9,500 average commits, and then the average actual is 17. And I wanted to ask you, you kind of dove into a few of those reasons before, like, or I think Sasha mentioned the technical abstraction, making it easier to access these yields. But I wanted to ask you your own opinion about why that might be. What creates that huge discrepancy between those numbers? The only thing I can think of, because I've been getting more and more into DeFi lately, is that these yields are wholly unexciting. With small amounts of money, like if you're putting $17 into a 10% yield, you're never going to make money. If you're putting $1 million into that, like an institution or one of these whales that you mentioned, you're going to get a lot of money accruing quickly and then auto compounding, and it's going to keep making more and more. So you have that sort of gravity of capital, that momentum, if you will. So I wanted to ask you, do you think that's what's behind this huge discrepancy? Like, you're absolutely right. I've seen that almost nobody cares about DeFi for some reason. And it could also be that crypto doesn't care about these more realistic real world yields as well. We're used to talking in terms of X's and not percentages in crypto. So we're expecting to get rich overnight. So that's possibly behind why not enough people have been adapting or using this technology or DeFi platforms yet. But I just wanted to get your take on that specifically. Like, why are we seeing this resistance to starting to use DeFi? Like, I'm waiting for DeFi 2.0 or 3.0, whatever you want to call it, but I haven't seen it come quite yet.
yeah, I think generally right. Most people don't give a shit about the tech. I think most people are in it for the X's, and that's clearly
Yeah.
evident from like the meme coin season that we saw, and then meme coin season two. I think tokens are changing forever. I think, people had this idea of 2020, into 22 of like what a token can do. And I'm still a big believer in tokens. I think they're like a very dynamic stock, right? They can offer so many benefits that stocks can't or won't offer. But I think for too many people are trying to raise off a token now when it's probably not even that needed. I think we've seen that, right, with the flood of so many projects coming out, Pump Fund coming out with millions of tokens, the liquidity not quite being there because the market dynamics have been up and down because of the Trump administration and what's happened there. I think it's become extremely difficult for projects to actually raise off a token, and actually a lot of VCs are now looking at equity plus a token warrant, right? Because if you invest in a token, I can delay it 6 months, 12 months, 18 months, whatever it is, or maybe I'll run out of capital and never launch it. But with the equity, you'll always own a portion of the business, the actual business, by a legal right. So I think that's sort of flipping a little bit more that way. So yeah, people don't really, and on the back of that, then I think the reason why memes are so popular is because there's 100% of the supply on the table from day one, right? And so when you do raise off VCs, they get in at a lower level, and they tend to sort of dump maybe on people who are just coming in. And there's not really retail here yet, or the retail is spread too thin. So as soon as the token launches now, it's like minus 80% within the first week after TGE. So there's a whole host of problems here, and I think people are just sick of that, and people want to make X's. I think, last year you had like DeFi summer, or sorry, last cycle you had DeFi summer, you had GameFi winter, you had a metaverse, right? Remember the metaverse? My God. That absolutely went crazy for a while, but you had these narratives. And we saw a little bit of that in January with DeFi and a couple of others, but it hasn't really happened like it has for memes. And so I think people don't really care about the tech, as you say. I'd rather put $20 into butthole coin and hope it does 1,000x than put it into a protocol that has 20% APY. Like, it's just the reality of the world. It's the way we are. I think there's a wider societal thing there as well, without getting too much into it, which is people really have a lack of hope. They don't feel like they can save like they used to, like their parents did. They don't feel like they can just go to work for 30 years and then retire with a nice house and a nice car. They feel hopeless. And when you feel hopeless, you don't save. You throw your money, gamble it away to try and make your 1,000x, or get enough for a deposit on a house or whatever else. It's that mentality switch. I think, with society. And it's also way more materialistic as well than it was even 10, 20 years ago. Everyone wants a Lambo, everyone wants to be on the beach sipping margaritas, and so everyone's willing to gamble. That's just the way it is, right? That's just human nature. And crypto is, like, I always say this as well, great way to hide your gambling addictions, you know what I mean, behind backing
Wow.
these projects. But it really is, if you think about it, you get the highs and the lows. Like, my god, you get so depressed and you get so euphoric, and that's addictive. That's like dopamine. So I think there's an element of that, right, for sure. And then I think on the other side, like, why is there a big disparity between these two, right, between the whales, like you say, and the regular people? Well, the whales, I think, it's extremely lucrative for whales to be in DeFi. You're getting a base yield of somewhere like 5 to 10%, right, on staples. Amazing. You wouldn't get that in you might get it in bonds maybe, but 10% you definitely won't get. And it's being auto compounded every 24 hours. And you're working with projects that are backed by big VCs that are audited to the teeth. So you're getting that plus 20% APY on the token. And so you've basically a risk-free move here. You can deploy 1 million, 5 million, $10 million. You're getting 10% on that over the course of a year, auto compounded, plus 20% of their tokens, so that when they launch, you get access to more capital that you can sell and you can make more money. So for whales, it's like super, super lucrative. There's some whales in there. I won't name names or assets,
Oh,
but they have
name them.
hundreds of which
Name them. Just name drop.
well, like MBTC, right? Merlin BTC is a prime example of like a cartel that has like hundreds of millions of dollars. And there's like a couple of whales from what I can see. We were with the Mode ecosystem, so we were very close to them, and we've seen firsthand how a bad actor can act. And like, they can put in, 100, $200 million worth of like sort of tokenized BTC into an ecosystem and suck out rewards, right? And then like within like a matter of days, if they want to, they can just remove everything. And so there are a couple of players like that who are mega, mega wealthy, who are going around taking all the rewards. So it's very lucrative for them, and it's very easy for them to do it, which is why I think, looking at DeFi now, I think valuations are overinflated, right? Because it's very easy to scam the game, let's say. Um, and we can go into that a little bit more. But yeah, I'll pause there anyway, because I've spoken for a good bit. But yeah, that's why I think there's a big discrepancy, because on one hand, there's a lot of money being made by the whales and as a free ticket, and there's no money
Yeah.
being made by the average person. So
There's
Yeah,
like
it doesn't.
five topics we got to break down. Mello, go ahead.
No, I was just going to say, you're right. It's becoming the new paradigm too, because you don't necessarily need to invest. You just need to lock up your capital temporarily. You don't have to even risk that those assets. Basically, you're just parking it for a moment, extracting, and then migrating to another ecosystem. And you're absolutely right. I think that's all that's been happening in the last few years in DeFi, and that's why we haven't really reached the next phase yet. This dreamy utopian society where everybody's getting yield and cutting out the banks. It hasn't happened yet because people don't truly have access to those things, and if they did, they don't understand it. And they don't know how to use it, and they don't understand why it's special. Like, most people don't understand how much they're getting screwed by their own banks, let alone what this is doing. So I think there's an infinite amount of reasons why it hasn't caught on yet.
for sure, yeah,
I,
absolutely.
I wanna I wanna follow up. You made a really good point on these big players with a lot of capital, and it's a question that came to mind when we were interviewing another VC on the Boom Room. We were talking specifically about treasury accumulation vehicles, and I'm not sure how familiar you are with these, but essentially these like large scale arbitrage opportunities that are created from like the speculative value or the NAV of the underlying collateral and what those assets are trading for, like on securities or equities markets. And my big question was, are these opportunities going to be wiped off the map if we have a massive influx of capital coming in? We're seeing so much institutional interest. We've got like BlackRock and JP Morgan Chase, all these big banks getting into crypto. We've got more traditional finance based funds that are executing very professional trading strategies to try and get these double digit yields in this landscape. But are these opportunities, is the yield going to be wiped out if we've got like an influx of let's say, $100 billion coming in, and these protocols can only sustain so much yield or so many rewards to a limited number of users.
Yes and no. So yes, I do believe that yields overall will come down for sure. Um, I think the dynamic aspect of yields will always be there. Um, Lending borrowing protocols don't necessarily work off of the amount of liquidity in a particular pool. It works off demand, right? So if there's demand for borrowing, the interest rate increases, so therefore the supply side increases as well. So if you've got, $10 million or $100 million or $500 million in an Aave pool, if the borrowing increases rapidly for USDC on Ethereum, then the interest rate goes up, right? Because there's more demand for it. And so therefore they need more supply, so the supply side goes up. That might last for a week or 2 weeks, and then it might cool off again. And then base might pop because base is having a run on meme coins or whatever it is, and people are borrowing, USDC to buy memes. So this is how it sort of fluctuates a bit to a certain extent, right? And so you need to be able to move from Ethereum to Base or Base to Solana, or be able to capture that as and when it's happening. And that's where the optimization point comes in. But yes, generally speaking, yields will be diluted over time. It's just a natural occurrence. And you'll have like people obviously adding on extra rewards. So OP often will add extra rewards onto the native base yield pool in order to incentivize people to deposit liquidity. You need to have a solution that can capture that, and then as you're earning the OP, you're selling the OP back into USDC, and therefore you're creating more yield for your users. Sort of what Beefy does. But what I think people tend to not think about, again, short-term thinking, is I see all yield opportunities and all industries, if you will, and all sectors being connected by a blockchain one day, right? So you won't just have DeFi lending, you'll have BlackRock Build, you'll have commodities, you'll have real estate, you'll have all of these opportunities connected via blockchain. And when interoperability becomes, seamless to the point of where you don't even know what's happening. And again, blockchain is where online banking was in 1996. That's a comparison I heard. I didn't even know online banking was a thing in 1996. So, it's it goes to show how far away we are. If we can get to 2025 and you have these agents, right? And you go to your agent and you go, hey, listen, I want to earn 10% this year. I don't really care about, risk that much. Here's 10 grand. Just put it wherever you want and find wherever you want. You can have these little agents going around putting it on real estate and putting it here and putting it there and moving around your assets automatically and generating this yield for you. So you have this autonomous agent that's like your wealth manager that's creating the money for you. That's how I see the future of not just DeFi, but all yield generating opportunities on chain. And so I would look towards that, because then the opportunities are so massive that there's not enough liquidity in the world, I would think, that could possibly, cause a debasement of all the yield across all the sectors, if that makes sense.
Yeah, yeah, absolutely. I think, and I also suspect that this massive influx of capital is going to create new opportunities. We're going to see new innovations. We see a lot of tokenization of traditional financial instruments. We see a lot of traditional financial processes being adopted over into cryptocurrency or blockchain. And so it makes sense that there's enough opportunity in the landscape for people to be able to pick and choose. And the idea of introducing DeFi AI or AI-fi, whatever you want to call it, into the mix is really interesting too. I think this is completely uncharted territory where we're not going to understand like how they're operating when it comes to latency of being able to identify and deploy capital into certain opportunities, and then the dilution soon to follow, and then sort of like you said, adjusting or shifting capital around. I think that's going to be like a really interesting sort of like test it kind of scenario with all these infrastructure companies that are building these agentic AI systems.
Yeah, I think because you're so early, right? You think about the internet in 1996. Um, a lot of companies creating the tech now will be dinosaur tech in 5, 10 years. So you need to have a situation where, you're constantly updating, your systems to keep up with the latest tech. Because if you're raising now and you're building now and you're building what we have available right now, which is really sort of clunky, it really is, right? And also, like, you eventually have vibe coding, right? Which with smart contracts and with interoperability, you can't do it right now, but you will. Vibe coding becomes so good, it'll be like, hey, create me a fork of Aave, and do this and this, and somebody will be able to do it in a day. Create a fork with a branding and everything else, the full content schedule and graphics and everything else, and they'll just be like, boom, there we go. So it'll be interesting to see, how AI-fi or DeFi develops, because I think, like you say, we're paving the way in many ways for what's to come behind us, which is great because you have to do that as human beings. If a business doesn't work out, okay, it's unfortunate, that's business. But hey, you've probably done something insofar as paving the way for somebody else to come in. They can learn from your mistakes or whatever it might be. I think there's going to be a lot of situations where a lot of companies will build great tech, but they ultimately won't last because somebody quicker, faster, more dynamic, who's starting up a business with this new technology is just going to overtake you and over outcompete you, and that's just going to be the reality of the situation. So yeah, I see the need to constantly update to be a massive thing in AI-fi. But I do think, when we get to that vision that I said, and again, I could be wrong, but this is how I see it going. I think it makes perfect sense. Um, I think that's also, I think that might actually be even a Netflix or Spotify moment for finance, right? You don't need your bank to create wealth for you.
Yeah,
You
yeah.
have you have this autonomous bot that does it for you. You have full custody over it. It's like super, super safe because, safety has just gone like through the roof at this stage. Um, it might be eyeball scan as well. So good luck getting into that. You can't steal my private keys. You have to take my eyeball, I guess. That causes more problems, I guess. But
So dystopian.
but I'm just saying, like, I think overall, I think the future is very bright for it. I think it's just a matter of getting to where it needs to be.
Yeah, Sasha's probably going to kill me, but we didn't plan to spend as much time on DeFi, but it's been a fascinating conversation. So I just wanted to get one more question in. You kind of answered my first mini part of that question with like what FAI or AI finance is, and that's kind of been one of the largest, most prominent trends this year for DeFi specifically. Um, what role do you think that's going to play in the future, and what is your big prediction for like 2026? Because we're going to need to see continued innovation, and we're also probably going to see some massive risks. One off the top of my head is LSTs, or liquid restaking, which I think is a little bit scary personally, but I would love to get your take on that as well. But do you have any big predictions, hot takes for next year for the DeFi landscape and what we can expect, and as far as innovations or risks goes?
Yeah, I think, like, talking about LSTs and LRTs, going on that first, I actually said this back in early 24. I think that's going to be the next great collapse of crypto, right? It's going to be like 2008, right?
Oh wow.
You're restaking. Well, I think it has the opportunity to do so, right? If you take your ETH and you put it onto Lido or Lido, however you pronounce it, and you get ST ETH, and you take your ST ETH and you give it to Eigenlayer, and you get like or ETH, or I don't know what the derivative is. All of a sudden, if one chain breaks, right, you're screwed. But those are three like massive, well-respected protocols. That's fine. Now, if you take your restaked ETH and you put it somewhere else for X ETH, and then you put it somewhere else, and you put it somewhere else, and you're getting this compounded effect. Great, you're earning 15% on your ETH or 20% in your ETH. But one single project breaks in that chain, and there's a house of cards comes down essentially, right? And it's an absolute shit show. And I think that that's a very easy move for a scammer or somebody to exploit, to do, right? Oh, we got hacked. Sorry. All your ETH was taken out of our ETH pool, but you still have your X ETH, which is valueless now because you can't redeem it against your ETH because, well, we don't have your ETH anymore. So sorry about that. Goodbye. So I think it has a potential to be a big problem. As far as innovation goes, I think like with anything in crypto, when a new thing comes along, it's a new shiny object, right? And the fact is that most people in DeFi or DeFi just haven't built anything of substance, right? There's a few big players out there who've done extremely well. Obviously Giza is one. I'm a big fan of them. They've built sort of this autonomous agent on Base, and there's some other sort of players that are doing quite well. in terms of like the single chain solutions. The interoperability piece is still difficult because it's trying to track assets across chains is the difficult part. That's something that we're looking to solve. But for the most part, I think it's like with anything, it's like these AI agents is just a chat GPT wrapper, right? With somebody who posts
Yeah.
on X for you, or gives you some information about the weather that pulls from BBC, and it's just like it's so rudimentary right now, right? And a lot of people are doing it to cash in on whatever rush there is. So I think the big development, I think, for DeFi in a roundabout way is almost like interoperability. I think next year, I think interoperability is getting much better and quickly getting better. I think the better interoperability gets, the easier it is for these sort of agentic systems to sort of plug in and use them and offer value to people. Um, so for us, that's the main thing that we're watching, is the interoperability aspect of it all. And then of course there's always the stable coin blockchains, right? I think that
Oh yeah.
that's very interesting. I'm so surprised that somebody hadn't brought something like that before. I'm annoyed at myself that I didn't think of it before. It just makes perfect sense, right? But I think that they're going to offer great opportunities as well in terms of yield, on ramping, off ramping, access to institutions and whatnot. So keeping a close eye on that.
Oh yeah. That's an incredible avenue for we're working with a project now, and the draw is access to permissionless institutional yield. And so that's like a really great avenue to streamline access towards like an institutional trading desk, or the yield from which. And it's interesting seeing like this growing interest again from institutional capital, and how so many lessons and processes are kind of being copy pasted from traditional finance. And I think the latest kind of meta that many people have been buzzing about, it's been around for a little while now, but the perps markets, and you mentioned it before as well. This is something that's sexy for both retail investors that can speculate on the future, just like a futures contract in traditional markets, but also it's drawing a lot of interest from institutional players. And so I'm curious, from your perspective, you talked about interoperability being the next kind of maybe big development or innovation. But do you see anything along the lines of like perps markets or other types of instruments that might be like the new emerging meta for what's being copied over from the traditional financial markets? Or do you think it's just like it's kind of up in the air? We just have to see what happens, like how creative people get with using this infrastructure, but like taking inspiration from what we already know from this other industry?
Yeah, great question. I would say I think I think perps were very hot there a few weeks ago, right? And everything was sort of moving. You obviously had Hyperliquid, which has done tremendously well, I think, in terms of a project. And then you had like Aster as well, which came obviously, which was the BNB side of things, and that sort of kicked off this sort of this run. And then you got prediction markets as well on the blockchain, which have been hot recently. But I think these will come and go. I think perp exchanges will do really well because the decentralized element means they're up 24/7. They're very sort of open book, for want of a better term. People like the sort of the transparency of it. They have their problems, but it is being fixed. It's fixing a lot of issues that are in the sort of traditional finance exchanges, I would say. And that's the same with decentralized exchanges, right? Binance went down during the crash, Coinbase went down during the crash, Kraken went down during the crash, Uniswap didn't. So I think there's good stuff there with the decentralized element of it that people love and they trust. And I think that's really building the better solution than what we currently have. But in terms of meta, I see RWAs. I mean, RWA is such a broad term, right? It's like DeFi, or it's even bigger than DeFi. It's like AI. So RWAs, I think we'll see more and more people trying to put these traditional finance investment vehicles on chain, right? So be treasuries on chain, bonds on chain, art on chain. I think there's real estate on chain. I think there's going to be a really big push over the next few years to bring the world on chain, right? And I think there's so many benefits for that, both from a yield perspective, but also from a capital efficiency perspective, right? At the moment, I mean, in the US, it's super quick to sell a property. In Ireland, it is a nightmare. right? But if you want to, for example, let's say we get to a position where everything's on chain and I want to sell my property. And as soon as that property sells, I want to move it into gold or I want to move it into stocks, right? There's no middleman, there's no bank, there's no waiting for the funds to clear. There's no having to go into the bank to meet your manager to make sure everything's okay and sign a piece of paper. It's like, hey, just move it from here to here, right? So I think there's going to be real beautiful like development in that regard where people will have free movement of capital, settlement, and all the rest of it, which I think will benefit everything and everyone. And then there is stable coins, I think, which have been hot recently, but I think will continue to be really like a hot topic. I think you'll have, reward systems. So I think things like Tesco rewards. I don't know if you guys have Tesco's. That's like a shopping center here, or any sort of supermarket reward system will be turned into their own stable coins, right? Their own dollars. You'll have like Amazon dollars, for example, or you'll have I don't know, what's another major retailer? Um,
Walmart.
Walmart
Yeah,
dollar, right?
actually,
Sorry, I blanked there, but yeah, Walmart dollar. So what do?
Oh
You
no.
buy your goods, you earn in their own, like maybe their own stable coin, and that own stable coin can get you discounts off other things, but it's their own capital that they own, right? And so it's just instead of them giving you a couple of cents in USD, it's in Walmart dollar denominated value, and you can do a lot with that. And I think there's an opportunity for stable coins to become reward mechanisms. Um, More so actually than probably taking over the financial system. I think you'll have a crackdown at some point where US dollars or euros or pounds will go, well, we don't want hundreds of variants of our money floating around. You might have a few big players, but ultimately, I think reward mechanisms offer a great idea. MasterCard, for example, Visa dollars. I think that they can be very, very interesting on chain, and what they can do with those on chain to generate more interest for their users or more rewards for their users. So I think that will be quite a big thing as well. Yeah, I would say those two for me are things that I'm looking at and thinking of. I think that they're both interesting.
yeah, I think if they do let that happen, it will be Circle and Tether and those type companies allowing wrapped versions of their tokens, like kind of as a B2B2C service, if at all. But I think you're right. Like some of these companies are already exploring their own stables. Like Walmart, I think is going to have their own stable currency. I don't know if it's pegged to the dollar or not, but it will be a currency for Walmart. But yeah, that sounds in line with what I foresee happening in the next year or two. But we've spent plenty of time, and there's infinite topics in DeFi that we could go into, and we probably will go into in spaces in the next few weeks or month. But we wanted to turn our attention to like fundraising, because you mentioned some interesting points about launching a token, and this kind of really hyper agile stock basically is the way you described it. But we wanted to just bring it back to like Earn Network and your experience with fundraising so far. You said you put some of your own capital into it, but what has been like the fundraising trajectory for the company, and what are like the future plans? If there's going to be a token, or if you're going to raise more, or if you need funds to scale this, because that's the one missing ingredient right now.
Yeah, so for us, it's been incredibly difficult, actually. I'd say it's probably been one of the most difficult things that we've had to do, despite building the tech. It's actually been more difficult. And so people say to you, fundraising is the hardest thing until you fundraise and then you build the tech. It's like, well, we built the tech actually, and we found fundraising to be harder. So, and the reason being is, I think in crypto is timing, right? It's all timing. I think there was a huge capital deployment in late 23, early 24 for people setting up for the rest of the bull run that never really materialized. And most of the projects that were supposed to launch in the summer didn't launch. And then they were supposed to launch in the winter and they didn't launch. Then we got a brief, incline again. And so we raised a little bit, around 200K, I would say, back at the sort of May 24. So just a tail end of that with some angels. And then we partnered with Mode, as we said earlier on, and we got really into the Mode ecosystem, and a lot of their angels were really interested. And we raised another 200K. Like, don't get me wrong, it's nothing to sniff at, right? But then as people were getting bullish again, tariffs are announced, market collapses, everyone pulls out. Like all VCs we were talking to were just like, we're going to hold off and see what happens. And we actually haven't even seen a recovery from that since, in terms of alts. Like we have for Bitcoin, and we have for Ethereum and a couple of other majors. But in terms of altcoins or new projects, there's just not much interest there, right? Because everyone's feeling the pain. I think unless you've invested in some of the majors, if anyone who's invested heavily in alts, especially sort of micro caps or sort of mid caps, has probably felt a lot of pain, right? over this last year. And if you're a VC, which I believe you guys deploy your own capital, you've seen that as well, right? So a lot of people I've spoken to are way down on their investments. Some of them they'll never get back, and they're hoping that we'll get some sort of a bull run to be able to liquidate some of the capital. So, and this is why I also think that the token model is going to change, because it's no longer super easy to raise off a token, or as it once was, right? I think founders are finding that. I've spoken to a lot of founders. They're all in the same boat, right? I think VCs are all in the same boat. Most of them who invested heavily in new projects are underwater at the moment. I think also the fact that projects have built and maybe not launched a token, and maybe don't plan on launching a token, or don't know when they're going to launch a token, or maybe they've gone under and ran out of money, I think shows VCs that actually tokens isn't maybe where it's at before. Maybe we need to go more equity, which I spoke about. So I think the attitude is changing more towards maybe more of an equity raise with a token warrant, right? And then that way you can also go more towards traditional finance, or traditional VCs. I do think that traditional VCs are becoming a lot more interested in blockchain technologies, crypto technologies, but they only understand owning a company. They don't understand owning a token. And so the token's a nice bonus, right? You can say, hey, if we do launch a token, you get, basically 1 for 1. You get this token. It's a free play. It's extra money. It's instant liquidity. We don't have to exit. We don't have to IPO, but you get your capital back if we launch a token. So I do think that's changing a lot. And I see it as a positive thing. I think, ultimately, the amount of money that was being deployed into tokens that just did nothing or do nothing was getting pretty ridiculous.
Yeah.
But in terms of fundraising, in terms of the fundraising side of things, though, I think it's been difficult, not just for ourselves, but for a lot of projects. And looking back on it, there's a lot of things that we could have done differently or would have done differently. As they say, hindsight's 2020. But
Yeah.
it is what.
That was my follow up, just real quick. I think Sasha probably has a bunch of questions too, but what would be your biggest piece of advice here, biggest takeaway from the fundraising process? Because I imagine a lot of founders watch these interviews. So if you had any specific advice, specifically around when to start raising funds, because if you can afford to not raise funds, maybe put that off. Or we're starting to see more companies just launching and making money before they decide they opt to create a token far in the future. So these are some potential ideas, but if you had any specific takeaways that you've learned in the last few years.
Yeah. Number one, traction's everything, right? We went in with this idea that obviously we'd build this cool tech. I think this is probably, standard for first, second time founders, whatever it is. Definitely, extended first time founder, let's say now, back down first time founder. You have this idea of something that nobody else is doing, and you want to do it, and you think this is going to be great. And you spend the money on building it, and it is great, and then you need to pivot anyway, right? Because you haven't thought about all the steps through, and you can't really think all the steps through because you haven't been through the journey. So I would say, first of all, traction is the most important thing. So number one, what's the most simple product you can build that can generate yield or generate interest or generate users and generate you revenue, right? So it could be something simple like, I'm going to, on Hyperliquid, I'm going to connect people in games on Hyperliquid via the API to yield opportunities on a HyperFi, right? So they deposit USDC, that USDC goes to HyperFi, they get 10% yield, and it goes back to the game, right? So automatically you're showing just that's one integration rather than all these different integrations and chains. So simplify it as much as possible to the point of where it works and you can get it to work and you can get users on board. Number two, partner with a single chain. I cannot stress that or emphasize that enough. Start off with just Hyperliquid or just Polygon or just Arbitrum or just whoever it is. And try and obviously if you build out a product, do bootstrap if you can, right? Get it down to its most simple form. Do not work with freelance developers ever. Go talk to 5 or 6 dev shops if you don't have a technical co-founder. To find a technical co-founder, ideally, if you can. If you can't, and you're not one, go to dev shops, get quotes, get final quotes to deliver this thing. How much is it going to cost? How long is it going to take? Get final quotes, compare them all. Do your due diligence. Talk to the clients who worked with them previously. They'll probably have case studies. Reach out to them, say, how did you find working with these guys? And then when you've made a decision, which might take a month or 2 months, I can guarantee you that 2 months of spending that time will save you countless time and heartache and headaches and money later on down the line. People get FOMO in this space because things move quickly. They don't move as quickly as you think they do, right? So, it moves fast, but not that fast that you can't take time to really plan it out. So don't work with freelancers, work with dev studios, or find a technical co-founder. Build the most simple solution that you can. Start off with ground zero. Who's your ideal customer? If we're starting down here, if we're starting with crypto, are you looking for degens? Are you looking for people who are looking to save their capital at like 10% APY? Find your customer, partner with a single chain, deploy that, get some traction, and then get some initial capital in as well if you want to raise. I think in crypto, technologies are very expensive anyway. I think you do need to raise to some extent unless you can find product market fit instantly and you've got a great business model. That's another thing, business models. DeFi has horrible business models because you need, hundreds of millions of dollars or tens of millions of dollars least in TVL to actually make any money off a 10% performance fee, right? Because you're only making 10% off the yield. So if you're averaging 10% yield, you get 1% of what the total TVL is. That's, you need to be at the top, the top whatever 10th percentile, I would say 20th percentile to actually make a profit in DeFi. So all these things need to be considered first and foremost. Once you try and raise off angels or off syndicates rather than big VCs. They tend to be more dynamic. They tend to offer better advice. They tend to be more understanding. They tend to be more helpful. And VCs tend to really, want a lot more, a bigger return. They tend to be more overbearing from what I've heard. I'm not working with any big VCs, but I've heard that you get into bed with a VC, you're owned by the VC to a certain extent as well, right? You lose that agility, that adaptability. The business isn't as much your own as you would hope. But the idea would be, I would say, to do an angel round or a pre-seed round, and then profitable from there. And then you're laughing. So the business model, spend time on it, figure out how you're going to make money, look at other business models out there. If it's not viable, change idea. Because you do need a lot of capital, I would say, to get something like a DeFi, especially in DeFi AI, because you're building AI with DeFi, which are both very tech intensive, and a lot of capital is required. So, yeah.
Amazing. I sense a lot of trauma and pain in that response, but a lot of
I've,
good insights there.
I've
I was
written
gonna say
down
the
a
same.
spreadsheet because I've made just so many mistakes. I was like, I have to write these down, otherwise I'm going to forget them. I sat there with a spreadsheet and I was like, I might as well write down my trading mistakes as well and my relationship mistakes. Like I might as well just go all out. I just
Yeah.
writing down like tabs and tabs of everything. So if I can look back on it and go, okay, like one, for example, crypto really focuses on marketing, right? Market, hype. Garbage. Don't focus on that at all. Like, don't spend any money on marketing. This is coming from a marketer.
Ooh,
Like
Yeah.
zero money
hot
on
take.
marketing until pre-TGE. Build the basic form of the tech, bootstrap it if you can, partner with a chain, partner with the protocols. Go to the chain directly, Polygon, say, hey, I've built this solution. This is what we want to do. Can you intro us to other teams in your ecosystem? This is who I'm interested in. Speak to those teams, do co-marketing campaigns, do whatever you want with them. You can build some initial traction there. People love to be early. Hey, we're offering the first 100 people into this Telegram group for early adopters. Build a bit of a sort of an army there, an ambassador army who are going to vouch for you and fight for you, and go that way. You spend any money on marketing before you're like 6 to 8 weeks, maybe 3 months out from TGE. It's a waste. It's a massive waste.
Oh man, 100%. This is an impressive amount of actionable advice that's coming from you, and I just want to tell our audience members: listen to this man. This somebody hurt this man, and he knows he's taking these lessons with him, and that's important, right? You in the startup journey, it's inevitable that you are going to make mistakes. You're going to screw things up. Every lesson has a price, and you have to take the most expensive receipts with you. And otherwise, you're not going to make it. That's the simple fact. And so all of the advice you've given is gold. I love this idea of like don't spend your money on marketing until you actually get to a point where you notice that it's going to have some value or return when you do spend it. This idea of speaking with angels and getting them on the cap table, I think, is instrumental. You have a much larger pool of angel investors to pull from, and the fact that they're angel investors mean that they are more singularly focused on innovation or tech or a subject, and they're more likely to be involved in supporting your company along that journey. So this is incredible advice, and thank you for dropping all these knowledge bombs in the boom room. We've got to wrap it up, unfortunately. But before we do, I want to ask you another question around Earn Network. So give us an idea, what is in store for the future of Earn Network? We talked about expanding or the growing interest in interoperability infrastructure in the world of DeFi. We talked about the prevalence of uh, DeFi AI or AI-fi, however you want to call it. I still don't like either of those terms, to be honest. And we talked about massive influx of growing institutional capital that's coming in. So this sector is primed to grow or change over the next few months to a year. So what do you guys have planned? What's on the roadmap? What's coming next for Earn Network?
Yeah. So for us, my biggest pet peeve has always been that, like I said, DeFi is inaccessible to the majority of people. I sort of see DeFi as a sort of like a bit of a circle jerk, as I say. It's just DeFi solutions make DeFi easier for DeFi users. That's what's happening, right? So the same 10 million people that are in DeFi are just getting better solutions to do the same shit that they've always done, right? But it's not bringing new people in. And there's some people who are trying to fix that, but it's still very early stages, right? Is it Infinix? Infinix? That's Synthetics
Yeah, yeah,
founder who's
those are
doing
good
that.
ones.
Yeah, Infinix, I think it's called. Anyway, they're trying to do something like that. They raised like $70 million. Like that's what you need for B2C, right? So, but our thing is like if we can't bring the mountain to Muhammad to the mountain will bring the mountain to Muhammad, essentially, right? As the saying goes, right? So we'll bring DeFi to users rather than users to DeFi. And how do you do that? Well, you do it through a B2B solution, right? So if we can have our API on games, on marketplaces, on launch pads, on perp exchanges, where people don't actually have to leave, the dashboard that they're in. We could even do it, for example, in any Web 2 capacity as well, eventually, right? So people could be, playing GTA, for example, and they have an earn button there where they can. I'm obviously would love to get with GTA, but I doubt it would happen. But the idea would be that a user doesn't have to necessarily leave or go to their bank or go onto a different platform to be able to earn the yield. They simply just deposit the rewards into the mechanism and they earn double digit yield, right? So that's the idea. So you need to create these solutions, I suppose, or we're trying to create the solution that makes it accessible to everyone, and brings it to them rather than them going to DeFi. So that's our main focus. Our main focus right now, we're on several EVM chains. We're going to be going non EVM next year as well, so we can capture more of the market. And really just trying to figure out exactly where our ideal customer is, because right now, we have, like I said, we've got like 12, I think 13 letters of intent. We've got 15 more businesses that we're in talks with, that are like in advanced talks, and they're all across the board, right? They're from everything from perp exchanges to games, and everything in between. And so we need to try and find out, well, where's the best market for this. And then, phase 3 for us is more of a modular approach, which is less of about like this sort of shared infrastructure and more about, hey, if you want to actually own this tech, we've built this out in a modular fashion where you can sort of, license it and whatever else, and you can have your own sort of tech stack. And that's important for institutions and for sort of bigger players like wallet providers and whatever else. So
Yeah,
that's
super
it.
exciting, man. I'm really excited to see how you guys plan to expand and then launch a meme coin. That's what we're all here for. We're excited to see and also invest in your cryptocurrency if you guys ever do plan to get around to that. I'm joking. I'm joking. But
Meme
Jeff,
agent.
it's been an absolute meme agents. Yeah, it's going to be a market. It's been an absolute pleasure having you on and speaking with you. Before we sign off, I'm going to ask my handsome friend Carmelo to ask our last and maybe most important question. But before we do, I want to remind all of our viewers, if you're enjoying this content, please tap that like button, throw us a follow. If you want to learn more about Jeff and Earn Network, make sure you check out the show notes below. We're going to drop all the relevant links there so you can learn about what they're doing and how they're trying to bring DeFi directly to you. And yeah, Carmelo, you want to take it away?
Yeah, as Sasha said, this is our always our closing question, and no cheating. You can't mention Earn Network, or just to be sticklers, no DeFi or DFAI. What are you most excited about for the next 12 months? It could be a niche, could be a narrative, could be a specific company or token. Uh, we just like to get a finger on the pulse to see what our guests are looking at for the next 12 months.
Yeah, I'm super interested in stablecoin L1s and of that kind. So you have obviously Tempo, which is more payments, which is backed by Stripe, which is completely different from likes of what's it, Plasma, which is more like it has a yield element to it as well. And then you got Arc as well from Circle, which I'm really looking forward to. We've sort of looked to dabble in their testnet. And there's a lot of these different, you got stable.xyz. So you got a lot of these players coming out, which I think will be really interesting for how it develops, stable coins in general in terms of payments, settlement, yield, and all the rest. So that, for me, I'm really keeping a close eye on that. Narrative wise, I think we've seen that a little bit. Stable STBL, which is Stable 2.0, which is from the co-founders of Tether as well, is interesting. We're seeing stable coins evolve. We're seeing a lot of new stable coins come around. So I think it'd be very interesting because for me, stable coins is real world money, right? It's just a digital format. And how you can use that in different ways to enhance people's lives. So for me, I'll be keeping a close attention to that. And looking forward to it.
All right. I mean, technically DeFi, but we'll let it slide because that was a good, well thought out answer.
It's funny how we've come full circle, right? Like the sexiest thing nowadays in crypto is stable coins and payment
Is US
methods.
dollar, yeah.
It's always going to be that way.
I'm most bullish about the Walmart dollar. Let's be honest here. Jeff, again, it's great to get you on here and speak with you about all things DeFi, about what Earn Network is doing. Thank you so much for coming on. We're looking forward to having you back on the Boom Room and some future panels to talk more about what's happening in this space and how it's going to continue evolving over the next 12 plus months. Thank you again.
Absolutely. Thank you so much. Incredible speaking to you guys. Really enjoyed it. And looking forward to the future.
Yeah, absolutely.
Thank you,
Man.
Jeff.
Cheers,
And
guys.
thanks again to all of our viewers. Until next time, stay safe out there, y'all. Ciao.